Hey folks. So normally on Frontlines Corner, we're talking about things from the perspective of founders and entrepreneurs. But from time to time, we do want to bring you the thoughts from the venture capital and limited partner perspective. And that's what we want to do today because times are a little uncertain and strange. And it does feel like things are kind of stuck, that things are moving at a slower pace. It's just harder to get everything done. And that isn't just down to entrepreneurs and startups. A lot of those issues are actually further up the food chain on where the capital is coming from. So I want to share a few thoughts on that. First and foremost, where is this coming from? So number one, of course, we've seen this with interest rates. And I have a good friend who is fond of saying money is supposed to cost money. But money hasn't cost a lot of money for quite a long time. In fact, a lot of venture capital managers out there haven't ever managed funds in an environment where money costs money, but now it does. So that certainly brings a level of complexity and more friction to the movement of capital. We're also in an atmosphere of uncertainty. It's very hard to tell what's going to happen. It's hard to tell, even someone like me who spent 20 years looking at the market, it's very hard to tell whether things are going to be better or worse in 6 months and why. And there's things like the fallout from the commercial real estate environment that could be really bad. And some people say, well, it's already kind of priced in. So it's just hard to tell what's going on uncertainty-wise. And then, of course, there is the issue specific in the venture space, which is a lot of our venture funds are pretty concentrated. They're concentrated in certain industries. So if you happen to be a fund, for example, in the food tech space or real estate and property technologies, there might be more distress in those portfolios than you would have otherwise expect. And that kind of is like the Titanic with watertight compartments. You're okay if a few companies are not doing so well, but if like a lot of the companies aren't, then as a fund, it's very hard to keep up with that and very hard to be looking at new funding. So those are some of the things that are conspiring to making the atmosphere really challenging. What that means is the funding environment, the vibe, if you will, of venture capital funding has changed dramatically. We've gone from 18 months ago where, you went out with a round and you were having competition around term sheets. There was all this fear of missing out. There were leads, maybe not plentifully, but certainly around and available, and followers were following those leads rapidly with real-time pressure on them. And people were not as worried about allocation. In fact, a lot of big limited partners, that is to say those who invest in venture funds themselves, didn't feel like they were over-allocated to the space. That's changed a lot. And there's a few things that are at play. One of them might be kind of unobvious, but because the public markets, the New York Stock Exchange, NASDAQ, Fortune 500, all that have come down, a lot of the big LPs, which is again the investors in venture funds, they are now over allocated to venture. So let's say they wanted to just put 10% of their total money with venture. Well, venture funds mark their books, usually on a yearly basis. The markets are marked all the time. So over the last year, maybe the public markets position's gone down, the venture capital position is kind of static. And so suddenly you have 15% of your portfolio in venture, and so you don't want to invest anymore. And this is a problem for a number of reasons. But first and foremost, because venture funds are kind of constantly raising, right? Nowadays, almost every 2 to 3 years, a new fund is being raised. And so if venture funds are in the market right now, they are having trouble raising money too, and that trickles down. So funds have limited capital. They're really focused on their existing portfolio and being defensive. And so, that's a problem in terms of deploying into new opportunities. Now, this is, of course, unfortunate because times like these, and partially because of this dynamic, lead to the best deployment environments, arguably, that we've seen in, a decade, and that we may see again in a decade. So, there's at least a very strong argument that at the bottom of these economic troughs, some of the great companies are created, some of the great investment opportunities and structures are created. And so as a VC, you have to think about, first of all, maintaining an atmosphere of discipline and conviction in your work. This is a time where you really want to be good about your processes and pick great companies and use the tools of our trade, which are good research and underwriting, spending real time with founders, getting to know the companies, making sure that you have good governance in place. A lot of the things we've talked about on this channel before. You really want to try and maximize that, hands-on platform function. We spoke, a few weeks ago about the platform report that just came out that demonstrates real measurable results to having hands-on support of portfolio companies. That is even more true when there's challenging economic times. And then you really want to make sure that you're transparent, and that you're transparent with your LPs as well about what's going on. This is none of the things we've talked about today are a secret, but it's really important to keep that open channel of communication and share what's going on in the portfolio. And if that means really reasonably marking your book down and accurately, then that's a really important part of being a manager. last thing I want to share is, what does this mean for the limited partners, for those LPs that are investing in venture funds? Well, there's a few things I want to share there. First of all, I think it's important for LPs to take a longer view on things like allocation. Look out further, assuming that, as it always does, the public markets will return, and we will see whether it's 6 months, a year, 18 months from now, the public market's coming back. Do you then suddenly want to be under-allocated to venture, especially given the fact that this is potentially a historic vintage to be involved in venture? So just generically speaking, certainly it would make sense to me for LPs to take a longer view on that. It's also important to remember that venture funds, the way we're structured, draw down over a period of years. So while you're making a commitment to fund, say, $1 million, $10 million, whatever it is, that's not all going to come out right away, given the way that most venture funds work. And that's a really important thing to understand. But last but not least, I think that transparency piece that I was sharing with the venture firms is equally important vis-a-vis the LPs, which is you should expect that your venture managers are being transparent and fulsome with their information. You should hold managers responsible for doing the things that they said they were going to do when you invested in them. And it shouldn't be automatic to just invest in the next vintage of whatever the funds are that you've already invested in. Keep those managers honest. And if you need to go find new folks, go find new folks. And I think if we all do those things, we're going to come through this time, as stressful as it is, as a strong innovation ecosystem, and we'll come back, just as strong as before.